Hey, welcome back. AMC Networks is probably one of the most interesting companies in the market right now for a few reasons. For a majority of people, they're probably that meme stock with cinemas that jumped together with GameStop close to 4 years ago, but they have nothing to do with each other. We can see a decent Q2 report without any special events. What's impressive is, once again, the amount of money they made. Another 95 million in a quarter for a 400 million market cap is huge. This company has consistently made around 3 to 5 or even 700 million per year, so they're at one of the lowest ratios you can find in the entire stock market. They announced some deals with Netflix, Sky and more, which is a nice way to generate some passive income from the series that brought their success. They also talked about some new exclusive series with potential, so that's gonna be interesting to see. If they can use the licensing money to develop new series and their own platforms, this could do pretty well, but more on that in a bit. Financially, they are in an okay position, with the current assets well above the current liabilities, but with quite a lot of debt coming in 2029. They even refinanced some debt maturing recently with a 4% interest and replaced it with a 10% one instead, which is quite a terrible thing to do. However, there is about $1 billion in equity on a 400 million market cap, so this is also very interesting. This, together with a price to cash flow ratio of 1, puts them in a very unique spot, and from a value point of view, this is extremely cheap. Now, one key thing to notice about this balance sheet is the amount of treasury stock that they have. They have a huge amount of treasury stock due to buying them at high prices some years ago. And that's something very questionable about the management. Why not repay the debt instead? If they did that, they wouldn't have that issue now and the company would have been infinitely better and the stock would have probably been much higher. But this can also be a potential boost, but only in case they recover, because if the stock keeps falling they won't be able to sell it for what they bought, if at all. By the way, treasury stock is recorded at the price of buying, not adjusted to the current price. So in reality, that is worth much less today. In a way, you can see this as liquidity, which they can use to buy another company or do whatever they want. So financially, they are in quite a good shape, especially if the stock price goes up and the value of those treasury stocks increases. I think if there is a recovery, this can have potential to do very well. But unfortunately, this has a couple of issues that can be seen as a deterrent for the market. With the new debt, they now have to pay around 185 to even 200 million per year in interest, which is very significant and can be quite an issue. They had a bunch of very successful series and we can see how one that does well can make a big difference in the profit. I guess the market is aware of this and you have to think about this series as the company's future income. When they had Breaking Bad, Better Call Saul, The Walking Dead and so on running, you could have expected a somewhat stable cash flow. But now, when this series ended and the licensing revenue is probably going to diminish in time and they have to maybe spin off and pivot around horror, there is a lot of uncertainty. Add the very questionable 10% notes that they issued to pay the 4% ones and you can see a big reason behind the current stock price. They also issued another 125 million worth of convertible notes with a 4.25% interest, which is a lot for a convertible note. But fundamentally, even at half of the average cash flow, that's enough to pay the interest and even reduce the debt, especially when you consider the cash that they have. They can then keep refinancing and be okay for a very long time. However, if they can make, let's say, 400 million on average, they can easily pay the interest, the debt and even have money for massive dividends and buybacks. You know, at such a low price to cash flow ratio, 50 million is a 10% yield for them and that's like half of an average quarter. Now, I think there is real potential for an acquisition. When you think about it from a potential buyer's perspective, if you pay an enterprise value of, let's say 3 billion, you get a company that's making 3, 4, 500 million per year in cash flows. Plus, all the IPs and media that you can then develop or make some spin-off and so on. That's more than a 2x, by the way. Even from a cost-saving perspective, a company like Amazon or Netflix that's paying licensing fees to show their series could see the potential. Or maybe another company that wants to develop the horror and mystery niche and potentially become the number one in that area could see it as an attractive option. Again, they still make a ton of money on top, so the risk they take wouldn't be that high. But they also have standalone potential. If they can manage this transition well and produce good enough series, or the expansion of Shudder, Acorn and everything next year goes okay, this could keep making a lot of money. They had a massive buyback program some years ago, and relative to the market cap, they still have a ton of money available. But sure, it wasn't a terrible thing to do back then, they couldn't predict the crash, but why was this the priority over reducing the debt? If they spent half of that money on improving the balance sheet, they would have been in a very good position right now. And then you have to think, can these people do what they have to, or will they make another bad decision and turn this into a terrible investment? You know, why did they wait until the last moment to refinance? Why take such a high rate? Why not wait a bit more for a rate cut? And so on. Ultimately, the management led to pretty much all the issues I see with the business, and these people are in charge of shaping the company's future. Maybe some activist investor could make a big difference, so that's something to look out for. But you also have issues from outside of the company. All the Netflix, Disney and so on are making bundles recently, and you as a very tiny company have to compete not only with those $100 billion companies, but now you have to compete with them working together. Combine it with the increase in interest, which has an effect on the company's liquidity, and you can see why they might be in trouble. They are in a similar spot to WBD, which I also analyzed and bought again very recently, but the companies are overall very different. Warner Bros. And Discovery together have a huge amount of content, and instead of 20 platforms, they unified everything into one which they are developing. Can it be a value trap? Maybe if they mess up the following years, but I see it as more of a turnaround play, which is a bit different. You know, if they really mess up everything, there is a ton of debt coming at the end of the decade, plus massive interest now. Maybe someone could buy them and recover some of the potential losses, but it still wouldn't be such a good scenario. But even in a neutral scenario, there is a ton of potential even with the new debt. They could also do what Warner Bros. Is thinking about, meaning a restructuring or spin-off, merger or anything that could generate some value. You know, put the cable TV plus a majority of the debt in one company and keep the high potential streaming and IPs in another one. Maybe then the market can see that probably not even the cable TV plus that one should be this cheap. You know, even that one could probably still be bought for scraps, let's say, and still provide some kind of value for some company. Again, there is a ton of equity plus a lot of treasury stock. I think the valuation will depend a lot on how they manage the debt. If the free cash flow drops to or below 200 million, this is where the issues will begin. In this case, we can probably continue to see such a ratio, meaning pretty much a 60% drop, because the interest and debt repayments won't be sustainable. They would be forced to do a spin-off or something, because otherwise they won't have enough money to pay the debt. They can maybe refinance, but if they keep doing it at 10% or even more in such a scenario, it's gonna be over for them soon and something will have to happen. But maybe there is some kind of a bottom, because a company they work with like Comcast, Netflix or even Paramount could buy some of the assets, and don't forget that they have a lot on the balance sheet. But again, it's about the market's perspective about the stock, because the company itself technically has all they need to repay the debt and even more. Now, assuming that they keep making 400 million per year, things would be very different. Again, 200 million is enough for interest, and they can use the other 200 for debt repayments, reducing the interest. Half a decade, that's over $1 billion repaid, refinance the rest and keep doing it. If they do that, then there is no issue from the debt, and if the market realizes, let's assume a ratio of 8, which is pretty low, but it would take a lot of success to get to a better one. Again, cable and content remain a significant issue. That's a market cap of 2.4 billion, meaning they would recover to around 55, which has been the price for about a decade. That's basically a 6x in, let's say, half a decade, which would be a really good profit. But again, to do that, they have to get out of cable and grow in DTC successfully, which is a big challenge, especially when everyone is doing that. And if they manage to do it, don't forget about the treasury stock, which they can sell back into the market and potentially unlock over $1 billion in liquidity. So I think this can either go pretty bad or very good, without that much in between. At the end of the day, they still managed to make a lot of money even without the old series, and we are right before a potential global expansion of several of their services. It's ultimately a matter of risk and reward, which, to be fair, looks very good. I think the management definitely messed up with the buyback some time ago and now with the terrible refinancing, so can they make it work? So there is still a risk to keep in mind, both in and outside of the company. But with rate cuts on the horizon and the potential shift from high-growth tech stocks to dividend or value for a bit, this could become more attractive for the market. I think this has potential to be a buy, but I'll have to do some more research before. Again, it's risky, but I can see myself opening a tiny position in the future because the potential is quite impressive. I think with this one it's ultimately a matter of how the management plays it, and I'd say the risk but also the potential are higher than WBD, which doesn't make one better than the other. For both, as they deleverage, develop and open the potential for dividends and buybacks, the stock price should naturally follow. If you know anything that I may have missed, let me know in the comments. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.